There's going to be a time afterwards for question and answer, so what I'd like to do now is introduce Paul Latta. And I've worked with Paul for, when did you get into this, Paul? 92, so almost 20 years. And Paul started off, like me, with an engineering degree from the University of Washington. He practiced engineering for a while. He then went to a very small, unknown school back east, I think it was Harvard or something like that, and got an MBA, which we haven't held against him. He's the only guy in the firm with the Harvard MBA, but we haven't held that against him. But anyways, he's been an analyst for since '92 at Ragen McKenzie, and he was an analyst. He was like the fourth or fifth guy we hired when we started the firm back in 1999. He's been with us ever since. He became director of research in 2004. He's done an outstanding job navigating very treacherous markets for our clients. Our research is often carried by Barron's. I don't know if you read Barron's, the financial press newspaper. Comes out once a week, and about every 6 months they do a ranking of the recommended lists of the various brokerage firms around the country. Goldman Sachs, Merrill Lynch, they're all there. McAdams Wright Ragen is there as well. And we have been near the top of that list a number of times over the years, on a 1 year, 3 year, 5 year record. And of course the danger of never talking about your past performance is once you start talking about it, you know the future performance is going to get bad. So we don't like to talk about it too much. But it is a testament to Paul's navigational abilities in these difficult markets. And very pleased to have him. And here's Paul Latta.
Thank you, Scott, for those kind words. Thought I'd talk a little bit about the stock market, and since that's a favorite topic of mine, also talk a little bit about some of the other asset markets, the bond market, as well as commodities and currencies, and other things that may be relevant to the stock market. As a little introduction, I thought I'd put up a chart of the S&P 500 over the last year, just to give a little flavor for where things currently are. And you can see that we've had quite a nice rally coming out of last summer. I think actually from the just in the last 8 months, we're up a little over 30%, which is certainly up is better than down, but always makes you a little afraid too when things move quite rapidly like that. Of course, we're still less than where we were in the 2007-2008 peak, but not really that far off actually. If you look at some of the other assets and how they've been performing, just looking at year-to-date numbers, actually the commodities have been rallying probably the strongest amongst the asset classes. And that's really reflective of, I think, mainly the tension that we've seen in the Middle East, although it's not just oil rallying, it's some of the precious metals, some of the agricultural commodities. There's been a fairly broad commodity move. Stocks have not quite performed as well as the commodities, but have held their own. Bonds have still been positive. And I think pretty much the way you would expect with the riskier bonds like junk bonds doing a little bit better than the safe bonds like treasury bonds. About the only asset class that we're showing down right now is residential real estate. And down, of course, this is year-to-date numbers, so not down a whole lot. That's a fairly slow-moving asset class. So I think we'll have more to talk about that in the presentation here. But if you look at stock markets around the world, emerging markets has been a popular investment here over the last several years. Actually, if you look just in the local currency, actually the U.S. market is actually one of the best markets so far, just year to date. I think we're leading most of the G7 countries as well as most of the BRIC countries, Brazil, Russia, India, and China. That said, we have had a bit of a weakening of the dollar here recently, and so when you measure those same investments, if you had taken an investment in some of the European stock markets, you probably would have done better, but mainly because of the lift of the euro, more so than the lift of the European stocks. So the U.S. is actually holding its own right now, but the currency is not. When you look within the sectors to see what areas of the market are hot by industry, I think right at the top of the list, energy stocks, probably no surprise there given the tension in the Middle East. Healthcare, actually probably a bit of a surprise to some, but I think there's been some potential restructuring there that might be pushing some of those names. In contrast, the telecom and financials have been lagging the market. And so energy is, I think, the hot sector across multiple measures, whether you look at the commodities or in the stock market. If you think about the stock market in total, we are still broadly bullish on the stock market. And I've listed here 4 reasons, and I'll have some supporting charts to talk a little bit about this too. But if you take a look just at the first quarter earnings that are we're sort of in probably 2/3 of the way through the earnings season right now, companies reporting their first quarter earnings. And we're seeing quite a bit in the way of positive surprises, a little bit more so than we've seen in recent quarters, and certainly a little bit more than what we've seen over the last, say, 10 years or so. About 3/4 of the companies that have reported so far are actually reporting positive surprises, and nearly 60% of the companies that are reporting reporting numbers that are followed through with a higher stock price, which to me basically says that a lot of the analyst estimates out there are a little bit too conservative and are not really fully appreciating the strength of the recovery in corporate earnings. And so there could be a little bit more left on the table there, or a little bit more in the market on a go-forward basis. Another area to think about, and Scott mentioned this about money markets not being particularly fruitful, with numbers being down close to 0%. And I think there's a lot of impatience out there with money just sitting idle, especially when you can see stocks out there yielding 2, 3, 4% on some occasions, and potential with equity upside. So a lot of people pulling money out of those low-yielding money markets and putting it back into the stock market. Valuations also remain quite reasonable. The S&P right now has a market multiple of 13.5, price to earnings multiple. 10-year average is about 16, so basically implies the stocks are cheap right now. Lastly, I might mention that there's been a lot of focus on how much debt the government has taken on, how much debt the consumer has taken on, but the corporate America has not taken on a whole lot of debt. In fact, corporate America, their balance sheets are actually comparatively healthy, and so another reason to be favorable on stocks. Let me just give a couple of pictures here. First of all, this is a chart that we refer to as money on the sidelines, and this is actually a 30-year long chart looking at the ratio of money deposited in money market funds divided by the total market capitalization of the overall stock market. And so essentially what it's measuring is how much money is either in money funds or in the stock market. And so when the chart spikes up, like we have here in 1980-81, that was the recession of 81. Everybody pulled money out of stocks, put it into money markets. And then as we came through economic recovery, the number dropped back down again. And you can see 2 fairly large spikes as we near present times. Clearly the dot-com recession in 2001 to 2003, we had a fairly substantial spike. And then we had an enormous spike, kind of a record-setting spike in 2008-2009 associated with our most recent recession. And so you can see the money is coming back off the sidelines back into the market. It's retraced most of its ground that it lost. But what's different this time is that in the previous recessions, those money markets were not at zero. And so, and no guarantee they stay here at zero, but it seems to me that the likelihood is that our current level, probably around 18%, is likely to punch through the 15% we saw during the mid-2000s, and perhaps not even plumb down to those 10% depths that we saw during the 80s. And so, in any case, something to think about. There is still money on the sidelines. A lot of the money has come off the sidelines. Probably most of that move has been made, but I think there's still more to go. This is another chart just looking, another measure of how expensive stocks are. We are a value-oriented firm, and so we do like to look at valuation. And this is actually a 10-year-long chart of the market multiple, and shows effectively that, well, 10 years ago stocks were expensive, and today stocks are relatively cheap. And this is, the price-to-earnings ratio. I probably should have extended this chart out maybe another 10 to 20 years beyond this to see that it's actually not just a permanently downward sloping chart. There's actually a cycle to it, and so what's also interesting here is, if you were to go back to the 80s, and again that's not on this chart, we did have a lower market multiple back then, around a 10 or a 12 multiple back then. But again, back then interest rates were running in the low to mid-teens, and right now we have interest rates pretty close to zero, especially for the short end of the curve, and maybe 3 to 5% on the long end of the curve. So it makes stocks that much more compelling. Again, another reason why I think money will probably flow to stocks here on a go-forward basis. Thought I'd change the subject over to the bond market too, and talk a little bit about interest rates. I know that the last I checked, I was looking at the Bloomberg machine to get the consensus view on where the economists are for when is the Fed going to be raising rates next. And the current consensus is first quarter of 2012. That's with a survey of, I think, 75 or 76 economists in the Bloomberg survey. And that's been relatively stable for probably about the last 4 months or so. They've been saying it for some time. I'm actually not really too far from consensus in my own mind about where we're headed. And I know our Fed Chairman Ben Bernanke just spoke on this topic about inflation pressures that we're currently seeing being somewhat temporary. And so the need to raise rates is probably not right at the top of his agenda. And in fact, in the very near term, what's probably at the top of his agenda is ending the quantitative easing that he's been involved in now since, the second round of it started in November of last year. So in our view right now, we're probably not going to get a whole lot in the way of movement in terms of short-term rates for the balance of the year, although we will likely see something in 2012. If you look at the longer-term rates, and I'll have a chart on this, and I'm thinking more like the 10-year Treasury and perhaps longer, we are sort of the view that we're going to be in a trading range of probably in the mid-threes, plus or minus, throughout for an interest rate over the balance of the year. And part of this reflects some of the interaction with the quantitative easing or the end of quantitative easing upcoming, and part of it also reflects what might be happening in the commodity markets and our outlook there. I'll get to a chart on that in just a moment. But before I do, let me just might also just mention in the muni bond area, when you think about bonds as a broad asset class, and you start dividing them into government bonds and corporate bonds and muni bonds and sovereign debt bonds and mortgage bonds and perhaps other asset-backed categories, the one that comes to mind as being sort of outside the norm recently has been the muni bond market, because they had a bit of a shock to their system when the government eliminated the Build America Bonds program, and so there's a bit of a pullback in those bonds. And at the same time, we've had issues with credit issues. I think our outlook on muni bonds basically is that the shock associated with Build America is largely over. That supply and demand is coming back into balance. The credit, however, credit situations are not over, and so you'll have to trust your bond trader, and I think we'll be bond next for that. Let me just show a couple of these charts here. This is the 10-year Treasury rate over the last 12 months, and you can see right now we're running at about 3.3% on a 10-year Treasury bond. And what's interesting about this chart is you can see throughout the summer that rate softened, which I think was partly due to a little bit of fear in the broader capital markets. But when the broader capital markets started to rally, the Treasury yields stayed low. And I think what was interesting there was the quantitative easing round 2 started in November, and Bernanke was supposed to be focusing his bond buying in most of the 5 to 10 year maturity range, and so you would expect that if that's the intent, that the rates would actually come down. And instead what happened was the rates came down before the quantitative easing actually was implemented, largely in anticipation of the actual event taking place. And then when the quantitative easing actually started, the rates went the opposite direction. And so sometimes it's tough to be a central banker, I guess. Broadcaster plans too loudly, and everybody front runs you. The implication, though, is that we have the end of quantitative easing in June, and that would suggest then that if we have a similar situation, that the rates are probably going to stay a little bit actually on the elevated side in anticipation of the end, and when the end actually happens, we could actually see some of those rates go down. So it's a bit of a contrary explanation. But when you think about that more broadly, that that sort of implies that, our call on rates being sort of in the mid-threes over the course of the year. We might see a little bit of a pullback in rates in the summertime if we do have some of this front-running issue taking place. But for the year in total, I just not likely to see much of a move, in my opinion. This is actually a chart just to harken back to the comment I made on the municipal bonds. And this is the iShares Municipal Bond Exchange Traded Fund, which to me, I actually chose this chart trying to find a representative picture of what happened in the muni bond market. And since this is a passively managed investment, I thought it represented sort of the chaos that took place right at the tail end of the year. But what you can see here is that we've actually had quite a little pickup here. The average for this particular ETF dropped from about a 106 down to about a 96 or 98 or so during the initial chaos, but we've popped back up to a 102. To me, that basically it says the Build America situation is mostly in the rearview mirror, but we're probably not heading back up to the 108 anytime soon, mainly because of credit issues. I would highlight again the expertise of our municipal bond desk and the fact that they do a very good job of trying to isolate individual issues. And they know the situation that's happening in California or the situation that's happening in Illinois. And I think they do a really good job of identifying where the value is in individual issues. And so, again, our desk does a very good job. I thought this particular slide here, I didn't have a good title for it. I thought I'd call it Other Thoughts. Because it's a bit of a random scattershot of topics that we get asked questions on a fairly routine basis. So I thought I'd just spend just a minute or so on each of these topics. To begin with, on the trade-weighted dollar, the dollar has been in the headlines for probably the last 5 to 7 years. And at some level, it's probably getting a little bit too much press because on a valuation basis, the actual decline in value, the big decline in value was actually 2001 to 2003 or so, and the declines in value we've seen in the last 5 years have actually been quite small by comparison. That said, we continue to view, if you look at the value of the dollar, we usually look at it on what's referred to as a purchasing power parity basis. Sometimes it's called a Big Mac index. Look at the price of a Big Mac here in America compared to in Europe or in China or other regions of the world. And I think on either of those bases, the Big Mac index or a more sophisticated measure of purchasing power parity, it's really hard not to say that the dollar is undervalued here. That said, in currencies, you can stay undervalued for years at a time. And so while we are value-oriented investors, we're not necessarily going out and running out and taking positions on stocks that we think are specifically going to be strong dollar candidates that could be undervalued for another 5 years, maybe more. In the near term, the dollar does seem to be clearly trading on interest rate parity. Europe has been raising rates. Most of the emerging markets countries, China, Brazil, India, they've been raising rates. And so a lot of the money is seeking out higher rate countries, even the U.S. At some point, Bernanke will raise rates again. The consensus right now, we're talking first quarter 2012. It's not that far off, so the dollar may be under pressure for a while. Might also mention, too, that the dollar does have a tendency to trade weak when there's an appetite for riskier assets in general. And so if people are seeking out investments in emerging markets, that means that the U.S. dollar investments go down in value as assets outside the U.S. go up. And so you can track that. The dollar's been basically a flight to safety investment. Thought I'd also mention the price of oil, mainly because, it's been clearly topical with the Middle East tension. Prior to the whole Jasmine revolution in Tunisia that sort of spilled into many of the Middle Eastern countries, oil, at least the West Texas Intermediate, was trading right around $85 a barrel. Brent was, I think, 88. Now they're both in the 105 to 115 plus range. To us, there's about a $20 to $30 sort of a war premium, if you will, on the price of oil. And I think this is what Bernanke was alluding to when he referred to inflationary pressures being of a passing nature. That if you look at periods of time over the last 20, 30 years where we've had Middle East tension, whether it be the Iranian Revolution in 1979 or whether it be the Gulf War in 1991, that these things do pass over time. No guarantee that this will pass as quickly, but I would agree with Bernanke that this will be a passing situation, and so therefore that price at the pump you're paying right now of $4 plus per gallon, I think maybe a year from now we might actually be able to get a break on that price at the pump. And so that also does have some implications for asset allocation and sector allocation, because if you believe that this too will pass, it's probably not a great time to be buying either energy commodities or, for that matter, energy stocks. They've had big moves already, and if we're kind of the opinion that this too will pass, then may not be want to be overloaded in those areas. Residential real estate, I know it's a topic on everybody's mind. It's been soft now for about 3 or 4 years. I don't really see a change in underlying pricing. I know that there's clearly an inventory issue there that has to be worked through. That said, I just make the point here on real estate that we've had a very low rate of new home construction that's been going on for years. And so when you look at the housing stock in total, if you were to assume a normalized economy, we actually have a below normal level of actual stock of housing. It's hard to really see that when there's an inventory of homes to be sold on the market. But if you just to draw a line through the curve, we're actually short of housing to the tune of 1.5 million homes nationwide. So I know it's something that will take probably a few years to work through, but when you think about that and what that means for today's pricing, to me it just says flat pricing for the year. I'd also mention another topic here, the labor market. It seems that economic improvement, there's a bit of a chicken and egg situation here where the economy would improve if we only had jobs. If we only had jobs, the economy would improve. One of these circular type of situations. And the unemployment number, I think the last number that we saw was 8.8%, which was not a very pretty number. It's an improvement from I think the peak at 10% plus or minus, but still not a pretty number. And we all know that in those labor numbers, we're not really fully accounting for all jobs lost. And there's a few sort of shadow statistics, if you will, where the actual number might be as high as twice what that unemployment number is. The only point I'd make here is that the unemployment number is a lagging indicator. What most people look at as a leading indicator in the labor market is usually the temporary help index. And I don't actually have a picture for you on that, but what I can tell you is that the temporary help index has improved, and it's improved quite dramatically. And it's retraced. It too dropped quite steeply during the 2008-2009 recession, but it's retraced about 3/4 of the drop already, which is actually quite a bullish sign for the economy as well as for the labor market. So that's actually an encouraging development. Lastly, I did just want to mention too that 2012 was a presidential election year. I know there's a number of data points out there saying election years have a tendency to be good years for the stock market. I think that's true. Hard to say what the issues are going to be just yet. It seems like those will be changing as we get closer to the actual debate season. But one thing that's certainly be on that list is the perennial debate when you're in tough times about austerity versus stimulus. And my hope actually is that the general polity will come down on the side of austerity, because that would imply that things are actually getting better. But we'll have to wait and see, but I'm fairly certain that will be a topic of discussion. Thinking about portfolio construction, what should your own portfolio look like? As we started out the discussion, still generally bullish on stock. That said, we had a fairly significant rally just over the last 8 months or so, and so generally we prefer to be buying on dips. I know cash on the sidelines, if you think about a typical portfolio that might be, say, 60% stocks, 30% bonds, and 10% cash. If you had a little bit more than 10% cash, keeping some cash on the sidelines, some powder dry, if you will, I think that would actually make sense given the size of the move that we've seen here recently. As far as the bond portfolio goes, I just put out a word of advice that a well-constructed bond portfolio that considers credit quality. And I'm pointing in particular at our bond desk, and of course I sit about 10 feet away from our bond desk, so I talk to these guys all the time, and I've developed a deep appreciation for their ability to identify appropriate risk reward. And so I would just point towards our bond desk in terms of building, say, a ladder for your own portfolio. Lastly, on the commodity rally, and to the extent that you might have an allocation into commodities, I do think that we're probably near a short-term peak. There's probably a few exceptions here and there when you think about the 20 or 30 individual commodities, depending on how those might be allocated, whether it be through an ETF or direct futures participation or whatnot. But I think broadly speaking, there's a bit of a softening story that looks like it's heading our way, not just for energy, but also for agriculture and certain precious metals. So probably a little bit bearish on the commodity side right now. With that, I thought I'd talk about some of the ideas that we've been working, in particular related to equities, since that's the bulk of what we do in the research department. Right now we've been favorable on staples, consumer staples, and the healthcare side as well. I would view both of them as sort of contrarian value stories. In the case of healthcare, we've actually seen a decent move on a lot of those healthcare stocks over the last probably 3 to 6 months or so. We do have Pfizer on our recommended list, on our focus list. That said, the whole pharmaceutical sector, I think, has been sold off so hard because of the threats to generics, or threats associated with generic competition, that to me, I'm almost agnostic as to which pharmaceutical company you buy. Whether Pfizer might have moved a little bit, but actually still kind of like Merck and Bristol Myers and Eli Lilly, maybe to a lesser extent Johnson & Johnson. I think all of those names are good quality names that are likely to see additional upside from here. Very, very inexpensive stocks. I might mention in our consumer staples area that a lot of those stocks have not really participated in the market rally, and part of that is because they've been facing the headwind from higher commodity prices. But if we're sort of the opinion that we're likely to get a break on commodity prices, in particular over the back half of the year, then that day in the sun could very well be in front of us here. We've got 3 names on our focus list right now: Campbell Soup, which I'm sure you all know, are familiar with that; Kimberly-Clark, which they make Kleenex and various other consumer paper products; and then Pepsi. Pepsi's actually had a bit of a rally here just recently. I think it's rallying partly in it looks like the sugar prices have actually started to decline just in the last week or so, and that might be a factor, as well as some better execution in their earnings. Not all of our stocks are based specifically on top-down themes. We do have, in fact, we love real company-specific stocks where a particular situation might come up where a stock may be sold off and may look especially interesting. We have that, and there are certain sectors like technology and consumer cyclicals where company-specific stocks come up more frequently. Others, like the oil industry, where they also trade on the price of oil, and you don't get that as frequently. But we have 3 consumer names in particular that I think look interesting in here. Nike, the stock pulled back here just a few weeks ago on a little softness in their most recent earnings report. We actually put Best Buy on our focus list also just a couple of weeks ago, a name that's clearly a contrarian name, but stock trading very inexpensive at only 4 times cash flow. And then Target, which the retailer that most of us know, a company that we regard as a very well-run retailer, also trading at a very inexpensive price. I might mention a couple of others. I've written down Washington Real Estate here. I could probably mention First Energy also in the utility space. I might mention one little tidbit on Washington Real Estate. It's a real estate investment trust. Pays a fairly big dividend, about a 6% dividend yield, which looks very favorable compared to that 0% money market. But one of the things I kind of like about Washington Real Estate is that being that it owns real estate in the Washington, D.C. area, it's one of the few real estate markets that seems to be healthy. And one of the reasons it's been healthy is because of government spending. And so if you own Washington Real Estate and you're upset about the government spending, you can then feel good about your Washington Real Estate. Again, we're still sort of underweight on sectors that have had large recent moves, and of course the energy sector is probably the poster child there. That said, industrials have also had a fairly big move, and there doesn't seem to be quite the same. Certainly, they're all beneficiaries of economic recovery, but trucking companies and the Caterpillars and whatnot have had some very substantial moves. And good companies, but we're probably not particularly bullish on those names right now. It just seems like they've had their day in the sun, and they're ready for a little bit of a rest, and we'll move elsewhere. So anyway, that concludes my thoughts on stocks that we like, and I sort of top down view of the markets. Okay. I think we're going to open it up to questions. I think the questions are for either me or for Ron or for Scott.
Not for me.
And I'm guessing anybody at this table here as well.
Any questions from the audience that we can direct to our speakers? Right to you.
Thank you. You didn't mention much about financials or technology stocks. Are those areas that you have research in, or do you have positions on the future of those sectors?
Sure. We do research in both. Sid Parak is our technology analyst, and Sarah Hassan is our bank analyst, and actually financials analyst. She does more than just banks. I know that she's been pounding the table quite a bit recently on Washington Federal, which is a name that... 17. Anyway, stock has pulled back. I think it was trading kind of in the low 20s here not too long ago. She has a target of around, I think, $24. I might have to check on that number, but I think that's probably one of the better run banking institutions in the state. A very conservatively run company, and it's, in a way, it's kind of its day in the sun right now, because I think it had been running a bit underexposed to the cycle, but now with the troubles in the banking industry, they're really set in a position to thrive with excess capital and have been able to exploit a number of these FDIC-assisted buyouts. So I think that's been one of our bank analysts' favorite names in the neighborhood. She's been recommending M&T over the last couple of years or so. It's a bank up in Pennsylvania. But the stock's had a pretty good move here, and it's starting to encroach on her price target, so she's not really pounding the table on it right now, like she is with Washington Federal. In the technology space, one of the nice things I mentioned earlier about technology is that there's a lot of company-specific stories in technology, and that said, a lot of the kind of the mid-cap to mid to large-size technology names have had really good moves here recently. Probably the one exception is the gigantic large-cap tech names, the Microsoft, the Cisco, maybe Hewlett-Packard, Intel actually had a good move just last week, so that might be the exception to the rule. And so from a valuation perspective, I think our tech analyst is favorable on Microsoft in particular. I think he's a little less favorable on the Cisco. Thinks that the valuations, while it's pulled back quite a bit here recently, he thinks there's just a little bit more to go. It's not quite out of the woods. He is actually bullish on one other name, a company by the name of Tesla, which is probably not information technology, but it's more automotive technology. It's a recent IPO about a year ago. I think it was in last summer, but it's the company that makes the electric vehicles. It's a great green story in terms of saving on the carbon footprint and reducing dependence on Middle East oil. It's still a development stage company, so it's a little bit difficult to value, but it is one of these stories that if it works, it could be perhaps a multiple-fold improvement in stock price, but it also has a similar level of risk if things don't work. So in any case, he's been quite bullish on Tesla.
Great question. Do you have any other questions?
Hi. You mentioned the commodities that you weren't really, you were saying that the gold and silver had peaked out and were probably due for a pullback, but in the long term, let's say a 2 or 3 year window, the hard metals, if you wanted to get into gold and silver, would you you think that's advisable for a 2 to 3 year window strategy? And if you were going to get into that, would you do the ETFs or would you actually do the hard metals?
A couple of things about the precious metals. Silver has seen an enormous rally here just in the last 6 months, and it looks just a little bit too hot to handle for me. There could be more upside, over the next quarter or two, but I just feel like that one's probably a little bit overbought. Gold has, it's had a great move over the last 5 years or so, but it's not had anywhere near the level of the move that we've seen with silver. I actually like precious metals in general as kind of an insurance policy because that is sort of the go-to. It's the place to go in the event that there's world catastrophe, whether that be natural disaster or military situation or whatnot. That gold will be a store of value in some way. And so, having a small allocation into precious metals as an insurance policy, I actually think is a wise thing to do. I probably have a preference for the gold over the silver. It's not really necessarily a contrarian call, so we're probably not actually going to put a formal recommendation on it. But that said, again, as an insurance policy, I think that's a fairly wise move. I might mention too, my personal, if you want to take a position in precious metals, I have a very strong preference for the physical ETFs like the GLD or the SLV, just because I just think that those were brilliant innovations. Actually, one of the reasons why the precious metals have risen so far and so strong is because of the financial innovation. It's made it so much easier for all of us to buy gold or sell gold or silver for that matter. And so also something to think about, that there's a bit of a herd that's moved into those metals already. And if you look historically, financial buyers do dominate the pricing on gold and silver. It's not necessarily about the underlying industrial demand. It's pretty much all about financial buyers.
Another question out there? Martin? You guys work this out in advance, so I'm going to run back and forth.
Thank you for all that information. I wish I could remember most of it, but I'm going to count on Rod hanging on to this and advising me. How concerned should we be of another dip in the market? I mean, a major dip. You hear about that occasionally, given the fact that, the federal government is in tremendous debt, states are in debt, money is being printed, and is that affecting the stock market artificially? And can we see something down the road? And what can we do to sort of insure ourselves a little bit? Thanks.
Always concerned about markets to go down. That's my job to be a professional worry ward. But I usually look at the business cycle as about a 7-year cycle, and so if our last recession was 2008, 2009, the prior one was 2001, 2002. The one before that was actually a fairly lengthy period, about 10 years, and the one before that was also about 10 years, but then you had like 2 or 3 in a row in the 70s. And so I do see, my personal feeling is that we're out of the woods for at least a couple of years. And again, that's partly based on cycle timing and partly based on things like we talked about earlier with the temporary health index showing substantial improvement that's likely to lead to stronger improvements in the labor market. And at some point, perhaps even not going to lift in residential real estate prices, maybe out 2 years or so. And so it looks to me like the factors that kind of create the self-reinforcing economic upcycle are gradually taking hold. If I were to worry about something,